In this video, we're going to start talking about cash flow, and the way we're going to cover it is I'm going to talk about an overview of it, about why cash flow is important, and then the definition of costs, because this sort of finely defined what kinds of costs should be handled which different ways will help us calculate cash flow. And then I'll go into the basic calculation and then give an example. So you know that this is pretty much what the cash flows have looked like, the cash flow diagrams have looked like, where we have an initial investment and then ongoing income. And we want to make sure that the income is sort of more or justifies the investment. So this is the amount, the initial investment amount, and it's to be depreciated, which we're going to talk about what that means to be depreciated. And then we also have these after-tax cash flows. Now, up to now, we've been given these values, but in this, from now on, we're going to look at how do we calculate the after-tax cash flow. So we want to look at the calculation of depreciation, and we'll cover that in another video. We're going to talk about the calculation of taxes, again in another video. And then there's several other issues like working capital and sale of assets that we want to look at. In this video, I'm going to go over sort of a general example. I'm going to kind of just lightly cover depreciation and taxes so we understand the big picture, and then later we'll talk about it. Now, when we talk about costs, one of the things, really a cost or something that you spend money on as a company, there's kind of three different types. The first is capital cost, and capital costs are really these initial cash flows, these values, these initial one-time investments, and it's a cost for an asset that lasts longer than 1 year, and it's usually expressed in dollars. We use that amount to convert to depreciation for calculation of taxes. So we'll use that initial capital cost and we'll spread it over the life of and I'll explain that to you a little bit later. The next one is fixed costs, and I meant to indicate that these are all these fixed costs, these flat values. And that's an ongoing cost that's not dependent on volume, and it's expressed in dollars per year. So it's something like rent or maybe insurance that doesn't really matter how much you're producing, it's just always going to be there. And that other kind of cost is variable costs, and that's supposed to be expressed in these that go up and down a little bit. And that is because the variable cost is an ongoing cost that varies with sales and production, and it's usually expressed in dollars per unit. So like it costs $3 for every unit we produce, which is going to be the material cost and the labor cost. So and then if we produce more, then the variable costs will be higher. If we produce less, the variable costs are going to be lower. So we're going to use these sort of three different types of costs when we're talking about cash flow, and it's kind of important to keep them in mind. So here's an example of cash flow. So we start, and I'm going to go through each of the line items so we can understand what it is we're talking about. So the revenue is generally thought of as the volume of items sold times the price per unit. So in this case, in this example, I have 1,000 units that are sold for $10 each. So that's $10,000. The next one is the cost of goods sold. Now this is what we on the previous slide referred to as variable costs. So it's the same units sold, 1,000 units, but in this case it's dollars per unit costing. So it costs $3 per unit and we sold 1,000. That's a gross margin of $7,000. Gross margin is the revenue minus cost of goods sold. The next one is operating costs. These are what we called on the previous slide fixed costs. This is materials and supplies, rent, insurance, things like that. And then depreciation is the equipment cost spread over the life of the equipment. So I'll talk about that in a little more detail, but just this is the cost of the initial equipment, but it's spread over the life. From there, we are going to calculate taxable income. So in this case, we take $7,000 and we subtract out $2,000 and $1,000, and that gives us $4,000. And then for taxes, we take the taxable income, in this case $4,000, and we multiply it by the tax rate, which is often 40%. So that's why 4,000 times 0.4 is 1,600. The net income then is 4,000 minus 1,600, which is 2,400. Now to get to cash flow, what we do is we add back all non-cash items. So this is net income, and what we want is cash flow. So we take that and we add back depreciation. So in this case, depreciation was a negative. Remember, I took 7,000 and I've subtracted these values out of it. This case, it's a positive. I add it back. So we subtract it here and add it here, so it has no impact for depreciation or non-cash items. Another way that's in cash flow is calculated is by looking at, oh shoot, we shouldn't have done that there. Looking at a little bit different, where we have the revenues the same, the cost of goods the same, the gross margins the same. We actually just take out the cash operating expenses and we get the pre-tax cash flow, and then we take taxes out of it. And the taxes are calculated down here. We take the $5,000 pre-tax cash flow, we take out depreciation, and that's taxable income. You can see that taxable income here is the same as this taxable income here. Taxes are the same, 40% of taxable income, so that's $1,600. And then what we'll do is put that $1,600 back up here and take it out of cash flow. So the cash flow is the same, but in this case we're taking revenue minus cost of goods sold minus operating expense minus taxes is that. In this case, we did the same thing. We took out depreciation and we added back depreciation, so the values are the same. I generally use this form because this is the form that's used in accounting, and if you're an engineer, you need to understand how to use accounting. This is often how engineers think about it. So I'm going to mostly be doing it this way, but just if you can try to remember that it's the same as the other method. So in depreciation in this case is the tax write-off for capital expenses. So these costs are spread over the life of the assets. We will talk about depreciation in more detail, but I just want to familiarize you with that topic. So let's look at an example. The company you work for is considering an investment in a new assembly line. The line will allow the company to sell, 10,000 units per year for $5 per unit each. The new assembly line will cost $50,000 and will last for 5 years. And I'm saying use straight line depreciation, which I'll show you later. The cost of the raw materials and labor are $2 per unit. That's the variable cost. And the ongoing operating costs are $2,000. That's the fixed cost. The tax rate is 40%. Is this investment justified using net present value? So we're going to always look at this cash flow diagram. It's the same thing. We're making an investment and we're going to have some return. The problem is that now we need to calculate what those cash flows are. So the way I did it is I actually pulled out all those significant items on there. So the sales volume, the unit price, the cost of goods, the operating cost, tax rate, interest rate, and life. So I'm going to use that to do my calculations here. So revenue, first thing I'm going to do is look at straight line depreciation. So the equation for straight line depreciation is taking the investment amount minus the salvage value over the life of the project. So in this case, what I'm going to do is I'm take 50,000 minus 0, because there's no salvage value, divided by 5 is $10,000 per year. And so that I'm going to put it in both of those line items there. For revenue, I'm taking the sales price and sales volume, which is 5 times 10,000, 50,000. For cost of goods sold, it's $2 times the unit sales, 10,000. So now I have gross margin of 30,000. Operating expense, I have at 2,000. So that gives me taxable income of 18,000. So I took 30,000 minus 2,000 minus 10,000 is 18,000. And then for taxes, I just take 40% of it. So 40% of 18,000 is that, and I get net income is this value, and then I'm adding back depreciation to get cash flow. Now I'm going to show you the other method too, to show you this is the same method. So I start with revenue, I have cost of goods sold to get gross margin, take out operating expense, I then go down here and do a calculation of cash flow by taking pre-tax cash flow minus depreciation to get to taxable income. And then 40% of that is 7,200. So I take pre-tax cash flow minus 7,200 is the 20,800. It's the same value in either method. And then what I do is I just lay that out. It's going to last for 5 years, and I'm not assuming any increase in sales. I'm just going to be flat. So I've done this calculation for 5 years. Now I have an A value of 20,800. So now I just take that 20,800 as a positive cash flow and the negative cash flow of 50,000 in year 0, and I calculate net present value of 28,848. It's greater than 0, so it's a good investment. So that's what we've covered in this cash flow. I looked at an overview of the cash flow calculation, how costs are defined, the basic calculation of cash flow, and then I went through an example.